Hi, I'm Jimmy. In this video, we're looking at the truth about banking. We're looking at what drives the banking industry, some of the headlines that have come out recently, and ultimately how the banks move the economy forward or hurt the economy. So, recently, there's been a lot of news in the headlines about big banks going out of business. For example, Silicon Valley Bank. I recently did a video on that one. You had Signature Bank went under, or at least taken over by the FDIC, and then you had a bank like Credit Suisse also get bought out by UBS, I believe it was, and Credit Suisse, they were never really a good bank. So it's been a while, but a lot of banks have had a lot of problems recently. So the real question is, are we in a banking crisis? If we were to look at a lot of the headlines, well, the headlines would imply that yes, we are in fact in a banking crisis. Maybe not 2008 banking crisis, but certainly it's not all rosy for banks at this point. But I believe that the actual reason banks are stirring things up or going out of business is because of the way banks work, the way banks actually go ahead and make money. Now, if you'd like to better understand what happened with Silicon Valley Bank, well, I actually did a video just recently on that bank, why they went under, how they ran into all the liquidity problems that they had. I will leave a link for that video in the description below. But crucially, for all banks, this is the Treasury yield curve. And the key thing to recognize here is the shape of the yield curve. We can see short-term rates are higher than long-term rates. That's important for a bank because what a bank does is they borrow money at short-term rates and they lend money at long-term rates. Right now, they're borrowing at a higher rate than they are lending. So they're ultimately going to lose money. Now, I hear what you're saying. Banks don't actually lend at the Treasury rate. And that's really true. But let's switch over to the Fed funds rate. So this is the Fed funds rate. The Fed funds rate is the short-term rate that, essentially, the short-term rate that banks borrow at. So they're able to borrow money at this rate. Now, let's say they had a customer, let's say a company like a Silicon Valley Bank, who had a whole bunch of corporate clients. Well, let's say any bank wants to lend to a highly rated company. And to measure what the interest rate could be, we could look at AAA corporate bonds. So this orange line is the AAA corporate bond rate over the past year. Now, the way banks make their money, again, they borrow at short-term rates, that's the blue line, and they lend at long-term rates. That is the orange line. And the spread between those two is the key. That's how much money they make for the money that they lend out. That's their profit margin, essentially, on the money that they lend out. But what happens when, over the past year, those margins have gradually been squeezed? In fact, just recently, we can see that the two numbers inverted, where the Fed funds rate was higher than AAA corporate bonds. This is a problem. You know the reaction that banks will have when they see that, well, we could borrow money at 4.75%, 5%, we can lend it out for 4.5%, 4.25%. You don't make that loan, you're going to lose money. Don't make the loan. That is why loans have slowed down. That is why banking has slowed down. By the way, this is very much deliberate. And I say it's deliberate because the Federal Reserve needs to get inflation under control. To illustrate what I mean, let's jump back to the Treasury yield curve. So, this is one of the most recent Treasury yield curve. Now, the Federal Reserve has been increasing interest rates. This we know. But they don't increase all interest rates. In fact, they control the overnight rate. The shortest rate we're showing here is a 3-month one. But they have a much bigger impact on shorter-term rates than they do longer-term rates. So, as they've been driving up interest rates, they have inverted the yield curve. The purpose of that is to slow lending, slow the economy, pump the brakes on everything, which will ultimately bring down inflation. This is all happening by design. Now, what we need to happen in order for things to normalize, banking to continue forward and for them to start making money again, or to start making reasonable amounts of money, is we need the yield curve to normalize. Once the yield curve is more normal, and that will happen when the Federal Reserve stops increasing interest rates and long-term rates are able to catch up. But once the yield curve normalizes, banks will start making a bigger profit. When they make a bigger profit for giving out loans, they give out more loans. More loans lead to more growth in the economy, and the cycle can continue. So I just wanted to dispel the notion that Silicon Valley Bank or Signature Bank going under were somehow the catalyst for banks to stop lending. This The inverted yield curve is very much the reason banks have slowed lending in many cases. When that goes away, that's going to ultimately fix the broader economic situation. And hopefully by that point, inflation will be under control and the global economy can continue to push forward. Now, we actually recently talked about this exact topic in a live stream that we do with our private investing community, where we do different live streams each week. We talk about building portfolios, talk about what's going on with the market, doing research. If you'd like to join to get access to the community and our valuation website, well, I will leave a link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really do appreciate it. Thank you, and I'll see you in the next video.